Jeremy, Palmer Square just launched 3 CLO ETFs. Before we talk about why investors should own them, what exactly are they?
Sure. So collateralized loan obligations are structured credit products that are essentially backed by 200 to 300 broadly syndicated loans, which are essentially levered loans that are used to fuel the economy through corporations. It's what they use to grow their businesses and so on and so forth. Those are packaged together and essentially tranched out via AAA all the way down to equity. And we take those instruments and we either sell them into the market to direct buyers, and as well as buy secondary issuance of CLOs into our products like ETFs that we have out there today, which are PSQA and PSQO.
And how do these CLO ETFs, there's a whole lot of acronyms in there, fit into a client portfolio?
I think the one thing that it does absolutely is provide diversification. And what we're trying to achieve with these ETFs is to democratize access to these asset classes. CLOs have traditionally always been an institutional asset class that have been bought by institutions. And what we're trying to do is package them in a way that advisors and individual buyers can use them in their portfolios to diversify as well as create lower volatility.
They also provide a whole lot of yield, which a lot of people are looking for in a volatile equity market. Can you comment on that? And also, you may want to talk a little bit about your Fed outlook, because I'm not sure if you've realized, but they have some impact on yields as well.
Sure. So typically collateralized loan obligations are floating rate instruments. So what that does is it allows them to reset on a quarterly basis. And that also allows you to stay in line with what the Fed is doing. And I think we're not prognosticators on what the Fed is going to do. What we can see today is that we're going to stay higher for a little bit longer. And I think this still provides the benefit of an attractive yield north of what you would see in treasuries, close to 5.5%, 6% in some cases. And that provides a lot of value for investors in their portfolios while they wait to see what the Fed actually does do. And it's a long-term investment that it provides that benefit on an ongoing basis.
Well, a word which keeps popping up recently is stagflation. So lower economic growth and higher inflation. So talk about how a CLO would perform, or a CLO ETF would perform in a period of stagflation.
What we're looking for primarily is stability. And in a period of stagflation where you have uncertainty, it's still going to provide this massive amount of diversification. Historically, CLOs have had a default rate, at least in the AAA and AA components of that structure, of 0%. And so you have a lot of stability, low volatility, and still creating yield in a portfolio when you're not sure what's going to happen with regard to stagflation.
And then finally, it seems though everyone's getting into private credit. There's private credit funds popping up all over the place. What's going on in the credit markets, and how will this ultimately play out?
There's always going to be opportunities in the credit markets like there are in the equity markets as well. Anytime we have dislocation, we're seeing things that make sense. And so in some cases, what we're doing is trying to start to rotate the portfolio into areas where we think there might be a relative value advantage. I think that it's an opportunity to take a breath and watch to see what takes place. And I think that what we're trying to do is be conservative. We've been trying to be conservative early on to take advantage of those opportunities as they play out into the market, Greg.
All right, well, thanks a lot for coming on and talking about it.
Thank you.